Okay, so the question was June 2003. June 2003, question 1. And we are going to handle the proposed option. And the proposed option is multiple products. Multiple products. And as we said, it is environment of uncertainty. It's environment of uncertainty. Is environment of uncertainty. Environment of uncertainty. So what we need to do is, first of all, we need to get the WACM. So weighted averages. Weighted averages. So in getting weighted averages, we need to know the weight of the weight of product T1. The weight of product T1, we are told this product T1, the demand will be 85. And then this product T2 is going to come in with a demand of 50. So the weight of T1 will be 85 out of 135. The weight of product T2 will be 50 out of 85 plus 50. So this is 50 out of 135. That is the weights, or those are weights in terms of units. We need to get weights in terms of shillings. If we get the revenue of T1, the revenue of T1 is 85,000. You multiply by T1, we are told the selling price will not change. We are not told that the selling price will change. So if you multiply, this then becomes 850,000 shillings. The revenue of T2, is 50,000. Product T2 is coming in with a selling price of 8 shillings. Is coming in with a selling price of 8 shillings. So multiply that. $400,000. Therefore, the weight of T1, obviously now in shillings, it will be, if we just take this one, if we drop the 4 zeros, none of the 4 zeros, the backing at 85 and the 40. I'm saying this, it is 850 out of 850 plus 400. So now that is clear. So that the weight of T1 in shillings will be 850 out of 1250. This first group of weights, this one were in units. Maybe you can put it T1X and T1, T2X. This is in terms of revenue. Then weight of T2 revenue will be 400 out of 850 plus 400. So this will be 400 out of 1250. Out of 1250. From there, we need to get the contribution margin of T1. The contribution margin of T1, we know it is 10 shillings minus the cost. The cost of T1 is 6, so that is 4 shillings. Contribution margin of T2. Contribution margin of T2, we know that T2 is coming to sell at 8 shillings and the variable cost is 5 shillings. So that comes in as 3 bob. Then consequently, contribution margin ratio of T1, contribution margin ratio of T1 will be 4, you divide by 10, which is 0.4. And contribution margin ratio of T2 will be 3, you divide by 8, which is 0.375. 0.375. So with that now, we can be able to get WACM will be the weight of T1X multiplied by contribution margin of T1 plus weight of T2X contribution margin of T2. So this one will be 85 out of 135. You multiply by contribution margin, which is 4, plus 50 out of 135 times 3. Times 3. Eunice, welcome. So solve and give me the answer. $3.6296. Confirm whether that is the case. Good. WACMR WACMR will be weight of T1 in terms of revenue, contribution margin ratio of T1, plus weight of T2 in terms of revenue, contribution margin ratio of T2. That way. Sasa, this one we know it is 850 out of 1250. You multiply by 0.4 plus 400 out of 1250. You multiply by 0.375. You multiply by 0.375. So if you take your calc, it will help you to say 850 times 0.4 divided by 1250 plus into brackets 400 times 0.375 divided by 1250. I'm getting 0.392. Because okay. So if it is okay, let's proceed to the next bit. Let's proceed to the next bit. The next bit. Now, for those who have joined, because I'm recording, I will set the record. But if you can copy very fast so that we move together, it's still okay. If you're not able to copy, I will set the recording. Now, the next thing is the expected profits. Expected profits. If you want to know the expected profits, how do we compute the expected profits? How do we compute the expected profits? Now, when we are in units, profit is given as WACM X U minus F. WACM X minus F. So our WACM is 3.6296 and the units are 135,000. The combined units. Then The fixed cost is 450,000. Get that? How much? That's 9,996. Okay. If you are looking for profits, when you are in shillings or in value, profit is given as WACMR multiplied by revenue minus F. Multiplied by revenue minus F. So sasa, hii WACMR, we already have gotten it here as 0.392. This one. And then the revenue is this total. Now, 400 that we had gotten. So it is 1,250,000. You minus the fixed cost, which we know it is 450,000. 450,000. $40,000. $40,000 shillings. Even these ones are shillings. There's a small difference that you notice here between here and this of the 4 shillings. It's because of the rounding. Remember, these ones were not exact. We rounded. So that's a small difference. The next thing that you can be told to compute is okay, the difference is, first of all, the answer for profit is always in shillings. Now, when we say in units and in shillings, it is simply a matter of language that is used in the sector. For example, if you come to a school like this one and you ask us about our sales, we will most likely talk in terms of how many students we have. I will tell you my class has 2 students or has 10 students. I will not tell you I have collected 50,000 or 20,000. If you go to a car dealer, most likely he will tell you in terms of how many cars he has sold. So those ones are talking in terms of what? Units. If you go to a hotelier, kama sahi ukiingia kwa hoteli that is next year, waulize their activity today, they will not tell you how many guests they have served. They will tell you up to now tumechukua hii pesa. Ukienda kwa mtu wa matatu sahi, umuulize how his day has been. Hata kwambia amebeba watu wangapi tangu afungue. He will tell you how much money he has collected. So that is him, he's talking in terms of shillings. But whichever language the business person is using, as the accountant, you are supposed now to work out this way, and the final result is this. Yeah. So if that is okay, to end to the next thing, which is and maybe I also needed to say this. when you notice this, this is when I will do a reconciliation, especially with a big figure. You tell us now there was because the error is because of this. You do a reconciliation if there is need. And it's also one of the ways used to perpetuate fraud. If you want to do fraud, you round up figures. So if you round up figures, you will report this. But in actual sense, this is actually the correct one. Hii ndio pesa iko kwa account. But kwa kitabu unaonyesha watu hiyo balance ingine unachukua. Yeah, it's one of the ways that I used to perpetuate fraud. You just create a small error, a point something. You can imagine a point 000 something in terms of the revenue of a company like Safaricom. You make a lot of money. Yeah. Good. That's why in auditing, because we are also not just running for the exam. In auditing, if the auditor comes to audit you, now you have what we call round figures. Figures zako hakuna yenye iko na decimal. Zote ziko rounded. You become a major suspect. Because your crowd, when you round, unaficha makosa uko ndani. The next thing that we need to know how to compute is break-even point. Break-even point. How you reconcile is to show is now to show it in terms of the totality. There is what we call the total approach. Total approach ni ile inatumikanga tu kwa FR, where you tell us total contribution. Unachukua, sinaona hii ilikuwa na contribution ya 4. Unasema 4 times, iko tufanye quickly just for curiosity purposes. Nipatie 4 times 850 is 400. 3,400. Haya, hii ingine ni 3 times 50. 150. So hiyo ni total contribution. Sasa less the fixed cost of 450. Those are units. Thousands. Have said, I need to have said the total contribution. It is 85,000 times 4. Yeah, I'll just write it 340,000. Hii ingine ni 50,000 times 3. 150,000. Then let's see a fixed cost of 450,000. Narudi kwa 40,000. So now, if you use the whole values without this average, naona hii average ndio tumekuja kutumia hapa please 3. So naona ndio tumetumia ikatupea this figure. But kama hatungefanya hizi roundings tutumie ikiwa whole, tuzionyeshe each on its own, then you can see the correct figure is this one. Yes. So the difference of 4 is because of the roundings. Yeah, that's how you show the reconciliation. Maybe we shall come across a question when you realize C.V.P is supposed to make work easier and faster, but only applies if the assumptions apply. If the assumptions are violated, the assumptions that you mentioned the last time, then you go to the total. Total approach ni ile tu tunatumianga kwa FR. Naona FR venye tunapanga product A imeleta hii revenue, product B unaweka revenue pamoja, alafu unaenda hapo chini unaweka costs zao pamoja. Yes, that's the total approach. Kila mtu anaonyeshwa yake. But C.V.P it combines them. Naona hapa sasa ime combine, unaonyeshwa just a single figure. So this one makes work easier. Yeah. So break-even point, maybe in units, in units, XBE is given as F out of WACM. So this one becomes, my fixed cost is 450,000. You divide by WACM. WACM ilikuwa na 3.6296. You have the answer? Okay. Sasa, let's now compute the break-even point in shillings. The break-even point in shillings. The break-even point in shillings, RBE, is given as F. You divide by WACMR. WACMR. So sasa hii itakuwa 450,000. You divide it by our WACMR. It was 0.392. So the answer would be in shillings. You have the answer. Okay. Let's go to the next. The next thing that you need to get is called standard deviation. Standard deviation for the profits. Standard deviation for the profits. So this one, the formula is given like this. Standard deviation for the profit of product 1 and product 2. It is equal to contribution margin of T1, which is squared. You multiply by variance of sales of T1 plus contribution margin of T2 squared. You multiply by variance of sales of T2 plus 2 contribution margin of T1, contribution margin of T2, obviously sales of T2, standard deviation of sales of T1 Standard deviation of sales of T2, correlation coefficient between sales of T1 and sales of T2. Now all these you get the square root, or you raise to power half. That's how we compute the standard deviation for profits when you have two products. Let us now record those figures. Contribution margin of T1, tunajua it is 4. So it is 4 squared. And sales of T1, tunaambiwa their standard deviation will now be 8,000. And we also know that for you to get variance, you square the standard deviation. Plus, contribution margin of the second one is 3. So you square 3. Then you multiply by the variance, and the variance will be the standard deviation of 5,000. You square it. Then you say plus 2 times 4 times 3 times the standard deviation, which is 8,000, times 5,000 times the correlation coefficient. The correlation coefficient we are told is minus 0.9. The whole of this, you get the square root. So solve and give me the answer. What is the answer? Yeah. Yes, you can round up or you can round off. 47,000 after the square root. Okay. 7,000. I don't know what I was expecting something to do with 40. Jackson, do you have a different one? 4 square times 8,000 square plus 3 square times 5,000 square plus 2 times 3 times 4 times 8,000 times 5,000 times 0.9, rather times minus 0.9 equals square root of the answer is 19, actually 19,621. Yeah. Maybe ile ya 9 ni subtract kutoka kwa kila kitu badala ya kutoka. 19,621.41687. And therefore, with that now we can get coefficient of variation for the profits. Coefficient of variation for profits. Coefficient of variation for profits. Now, CV we know so well, it is the standard deviation you divide by the profit times 100. So our standard deviation is 19,621.41687. So profit, you can decide which one to use. You can use either 39 or either 40, whichever you want. Let me use the 40,000 one. So that is how the question was supposed to be handled. I want you, ukimaliza hiyo, usome hii, we solve together. April 2021. Question 1B. April 2021, question 1B. Remember, I had said this question, I was to use it to take you through what happens in that. So I've done a lot of illustration. So read that in a minute. I found so.
Your practical mistake
So, maliza kusoma. April 2021, question 1D. I told you when you read the question, obviously you have an idea it has come from which topic, that is C.V.P. When you are in C.V.P, you need to know whether it is a single product or multiple product. So is this single or multiple? As in, do we have just one product or we have more than one product? Yes, so it's multiple. So it's multi-products. The next thing that you need to identify is the question in the environment of certainty or uncertainty. It is certainty kama hakuna probability, and uncertainty if it has probabilities. So what do you think? It is certainty. There are no probabilities. So with that having been known, the question is asking us to get the break-even point in units and in sales value. So let's now write the formula for break-even points. Break-even points in units. Break-even point in units. How do we get it? We know the formula. XBE, when we are in multiple, it is F, you divide by WACM. WACM. If that is the case, how do we get WACM? WACM, it is the weight. There are two products here. Eh? There is D and A. So it will be the weight of D, contribution margin of A, of D, plus the weight of A, contribution margin of A. The next question that comes up very quickly is, how do we get contribution margin? It is price minus variable costs. The other thing is, we now start identifying these items. And in identifying the contribution margin of B, the examiner has already given us. Ukiangalia kwa hiyo table, unit contribution is 150. And the contribution margin of A, the examiner was kind enough to give us, it is what? 90. We are already given that it is 90. So we need, now this weight, these weights will depend on when or which mix you are in. So hii kwanza nataka kuiacha. Hapa tunafanya ile iko general, then the specific tutakuja hapa chini. Tukuja kwa F. F is the other thing that we need to identify, the fixed cost. That one will not depend on the mix. If you look at the question, you can see towards the end hapo kuna direct avoidable fixed costs. Can you see 117,000? Are you able to see that?
Yes.
Good. And then there is also the common indirect fixed costs of that 9,000. So those are the two that will make the fixed costs.
So
156,000. Let us now go to the original mix. In the original mix, the sales of the total sales, X total, it is the sales of B plus the sales of A. And as you can see, the units of B, they are 1,200. And the units of A, they are 600. So that gives us 1,800 units. That's the original mix. If that is true, because
fixed costs. Going by the definition of fixed costs, that they are not supposed to vary with the 90. And according to this question, where they say direct avoidable fixed costs. Direct avoidable fixed costs. Meaning those ones will vary with the 90. And that was like maybe the only cost that is relevant to our division, as in terms of fixed cost, it is the 39,000. Bearing in mind again that when we are discussing about multiple products, we are supposed to sum the cost. So I don't probably like the examiner had done that work for us, and that's why we do the common figure of that right now.
Okay. What you have said is true, but not fully true. Why it's partially true is because your argument has considered the word direct only. It has not considered the word avoidable. A direct cost is different from a direct avoidable. Direct is the one that is purely dependent on how many units you produce. But a direct avoidable fixed cost is a cost that can be identified with a department, that department alone, and can be avoided by the department if it so wishes. But when we say it is fixed, when it is followed by the other one, what? Fixed, it means it is not depending on the units. For example, in a department, we have a person called HOD. Now, this HOD may think that I need a TIGAR, let me use that. A TIGAR or a messenger in my department. And according to the organizational structure, he has been given power to hire and fire such a person. To hire and fire such a person. So when he hires that person, the salary of that person will be fixed. But it is avoidable in that if he feels that he no longer needs the person, he can fire. Yeah. Equally, it can also apply even in situations where he does not have the power to acquire the item, but he has the power to decide whether he requires it or not. For example, you require a van in your department. In most of the departments, the HOD does not have the power to buy a vehicle. The vehicle is bought at the head office. But sasa wewe kulingana na shughuli zako useme yuko kwa head office ninahitaji gari. So the head office will buy the car iletwe kwako. Now that one is a fixed cost. When you don't need the car, unarudisha huko kwa head office. It is still what? Avoidable. But the unavoidable fixed cost, they are the ones that are determined by the head office. You have no say about them. For example, the space that you are using in your department is the head office that determines. So as the HOD, you have no say about that. So the meaning of this word direct and avoidable is that the cost itself is direct, but rather it is fixed, but is identifiable with that product alone. Such that if that product wanted to say, or that department wanted to say, we don't need it, there is a forever. But it does not depend on the number of units that are produced. So as such then, it falls under fixed cost. Yeah. Now this concept will come in March when you are doing performance measurement. Now as if it is a compute residual income, economic value added. Because as hapo ndio tunaongea mambo ya they are allocated, they are portioned, ni gani zinastahili kutumiwa kupima the success of that manager and so on. So after that, we now need to get the weight. So the weight of B will be 1,200 out of the total 1,800. The weight of A will be 600 out of the total 1,800. That is the weight. Haya, tuende now kwa tunatafuta nini? Remember we are still using these formulas, So tunatafuta huyu sasa. WACM. So WACM, now we have everything we require. This one I can write it as 12 out of 18. Is it the same? 12 out of 18 times 150 plus 6 out of 18 times 90. $130. So if it is 130, now I am in a position to proceed and say my break-even point XBE will be F, which I already know it is 156,000. I divide it by 130. I divide it by 130. 1,200 units. 1,200 units. So here tumejibu when we are in the original mix. Let's now get the proposed mix. In the proposed mix, we are told it is 1-1. So the total sales is the sales of B plus the sales of A, which we are told is 1 plus 1. That will give us what? 2. So the weight of B will be 1 in 2. And the weight of A will be 1 in 2. So I need now to get WACM. WACM will be a half of 150 plus a half of 90. $120. So I'm now able to get XBE, break-even point, as a fixed cost of 156,000. You divide by 120. $1,300 units. 1,300 units. Haya. Right now, for the next requirement, the next requirement is break-even point. Break-even point in shillings or in value. Shillings or value. Break-even point in shillings or value. If you are told break-even point in shillings or value, you start by the formula. RBE. It is F, you divide by WACMR. That's the formula we use there. So we already know our F. WACMR. WACMR. We do not have it given, so we have to compute. So it will then be the weight of product D, contribution margin ratio of product D, plus the weight of product A, contribution margin ratio of product A. How do we get the weights when we are in shillings? Weights are gotten in terms of revenues when you are in shillings. So the revenue of the revenue of D, the revenue of product D, the question already has given us 360,000. And the revenue of A, we are already given as 120,000. So if that is what we have been given, it then follows that the weight of D, or maybe I needed to have started with the total revenue. I needed to have started with total revenue. Revenue total will be the revenue of D plus the revenue of A, which is 360,000 plus 120,000, and that is 480. That is the total revenue, which is already provided. We did not require to compute that. But I'm doing it full because you may come across a question that will require you to do full. So the weight of D will then be 360. You divide by 480. 360,000 divide by 480,000. The weight of A will be 120,000. You divide by 480,000. How are their ratios? Are they exact ratios? 36 divided by 48. If they are ratios, you can. 36 divided by 48. Yeah, good. 0.75. So then this one should be 0.25. Yeah. Higher. What else do we require? Tuko hapa weights tushapata. Now we need contribution margin ratios. So contribution margin ratio, we know it is contribution margin divided by the price. Therefore, contribution margin ratio for D is, contribution margin for D is 150, and the selling price for D is 300. 300. So this gives us 0.5. This gives us 0.5. So contribution margin ratio for A. Contribution margin ratio for A. Contribution margin ratio for A is 90. You divide by the selling price of 200. 0.45. Sasa tuko na kila kitu that we require for this. So if that is true, then proceeds to become WACMR is 0.75 times 0.5 plus 0.25 times 0.45. Hmm? 0.75. So our RBE will be 480,000. You divide by 0.4875. $984,000. Eight. Now here I forgot to label kuanzia hapa kuanzia hapa mahali tulianzia hizi workings hii ndio ilikuwa ya original mix. Original mix ilianza hapa. Hiyo ndio original mix. Here it is our original mix. Zilianza hapa. Mahali tulitafuta revenue. So with that, let's now look at what happens with the proposed mix. Proposed mix. Now, in the proposed mix, the revenue for D. Unaona hapa tulikuwa tumefanyiwa. The examiner had already given us the revenues. But in the proposed, we are just given the units. We are told it is going to be 1, 1. So what you do, you take those number of units, 1, multiplied by the selling price. The selling price is 300. So that gives us a revenue of 300. And the same case you would have done if, for example, this is 5 units and 7 units, 5 to 7. So you just take 5 multiplied by the selling price, 7.5. Similarly, the revenue of A will be 1 times 200. That is 200. So the total revenue, the revenue for the total is 300 plus 200. And that gives us what? 500. So the revenue for the total is with that, we need to get the weights. So the weight for D will be 300 out of 500. I think this one is convertible to decimals without rounding. 0.6. If it is having roundings, it is not advisable you convert it at this point. Because if you round it earlier, the error becomes bigger and bigger. The weight for A, will be 200 out of 500, which is therefore 0.4. Then from there, we need to get contribution margin ratio. Oh, those ones you already have. They will not change. These ones, eh? So they are the same. So if they are the same, I just go straight now to getting WACMR. WACMR, it will be 0.6. That is the weight of D, multiplied by the contribution margin ratio of D, which is 0.5, plus 0.4, multiplied by contribution margin ratio, which is 0.45.
Is that revenue for me?
This one.
Underneath. Yeah.
How this one?
RB.
This one?
Yes.
Is the revenue for B.
Okay, those are the ratios will be 1, 1.
Yes.
1, 1. The 300 are
the selling price.
Yes.
You see, when you are in shillings, now we are in when you are in shillings. Now we are in shillings.
Yes.
The weights are given in terms of revenue, not in terms of units.
Yes.
That's why now, this being units, you must convert them to money by multiplying by the selling price. Then sasa hizi revenues ndio utatumia kama your weights. Yes. Good. Haya. Huyu naye 0.48. So with that, we have everything we require for us to get the RE or the R break-even point. The R break-even point, it is the fixed cost of 480,000. Equal 480. Foite itoka wapi? Kuna mahali tulifanya makosa. Hiyo 480 hii ndio haikuwa fixed cost. Hii ilikuwa revenue. So go back and make a correction. This one, it was the fixed cost. Fixed cost ilikuwa tumepata huko juu 156. Make a correction. 156. Let's start here. So give me the new figure here. 156,000. $320,000. Good. So sasa tukirudi hapa, instead of 480, it is 156,000. We divide by 0.48. $325.
Even our weights will change. Huh? Even our weights will change.
Where?
Our weights for the revenues.
Where?
Because we initially were used to the revenue.
Hakuna kingine cha chini, ndio?
That's okay. That's okay.
It's only this one. So 325,000. So I think we have answered that question. Yes. 7 is a lot. 7 inakutoa kwa 43 to 50.
Two? If they have to do CPA, they should not go to university classes. They should start here.
Why?
Because that I think in the university this might be 20 bucks.
This one, actually, those who have done CPA first, when they go to university, they do so well.
Yes.
Do so well because this one is a serious task.
You must even discourage wrong questions. They want questions, the questions that I ask must be fine. Now, when you want to, when they is a question of financial statement. I don't know.
I think that is a wrong approach because life is not that simple. You know, we are preparing for a life situation. You don't get life that is so simplified. Life is complex. So lazima tupatie. And I think that's the approach CPA is trying to use. When they see them bring the case studies, like in LL, unapewa 40 marks. Unapewa story mingi kabisa. Sasa kutoka hapo you find your way. Because that is the order of life. Life is never very straight. Even this MA used to be like that. Ukiangalia hizo maswali za kitambo, unapewa swali mzima a full topic. Naona kama hiyo tumetangulia kujibu. One question, one topic. So kama huna idea hiyo swali yote unakuwa hivi. Si kama hii tumejibu hii ya April. Unaona hii ni part D. So ukiangalia ABC, they have come from different topics. So you can still get something. Lakini kitabu ilikuwa swali moja kwa topic. So it is either you know or you don't know that question. So I'd like you to practice by trying November 2017, question 1B. Looking for another one, but and also when we are training managers, we must give them complicated things.
Singing through these over the exam like now which ones are relevant?
And also this one of May 2014. May 2014. Question 3C. And try those ones. Then we shall do some others in the next lesson. Thank you.